So I'm going to discuss how to give away your pension before the 2027 inheritance tax rate, but I'm also going to remind you of the proposed changes, including the potential for a 67% tax rate and what financial planning options people are already looking at now. So for many years, UK pensions have been a powerful tool, not just for retirement, but also for passing on wealth. And that's because, unlike most other assets, unspent defined contribution pension funds are largely exempt from inheritance tax, or IHT, upon death. But this is all set to change from the 6th of April 2027, and any unused money from a defined contribution pension will be subject to inheritance tax. Now, a defined contribution pension, or a DC pension, is a type of pension where you and or possibly your employer pay in with the hope that the value grows, but of course that is not guaranteed in any way. The defined part refers to the contribution amount, hence the name, and this differs from defined benefit schemes or final salary schemes, where the benefit amount is defined under the scheme rules. And defined benefit, or DB pensions, which provide a set income, are much less likely to be impacted by the rule changes, as they rarely leave a large capital sum, which is unsurprising given that MPs have access to a defined benefit scheme alongside many public sector workers. But first, I want to quickly explain the current state of play when it comes to passing on a defined contribution pension. If the pension holder dies before age 75, beneficiaries can typically receive the funds tax-free. However, if they die after the age of 75, any benefits received by beneficiaries, while not subject to inheritance tax, are subject to their marginal income tax rate. But in the autumn budget of 2024, the government announced a fundamental change. So from the 6th of April 2027, most unused pension funds and death benefits will be included within an individual's estate for inheritance tax purposes. So the government's rationale is to align pensions tax treatment with other inherited assets, encouraging their use for retirement income rather than for wealth transfer. However, this does introduce something that's being called the double taxation trap. So if the pension holder dies at or after age 75, then the unspent funds will be subject to inheritance tax, first of all, at 40%, and then the remaining funds will be subject to the beneficiary's marginal income tax rate. So this is from April 2027, but that does mean that you could get an effective tax rate of 67% if the person who's inheriting the pension has a top rate of income tax of 45%. That means that if they inherited a £100,000 pension pot and they took it as a lump sum, then they would receive just £33,000 of it after all of the tax has been taken. So yes, they could mitigate the taxation by accessing the benefits if possible over time, but the point still stands. And it's important to remember that nothing is currently set in stone, and we are awaiting details of the initial consultation on the proposed changes with the industry, which concluded in January 2025. There are going to be important nuances with the proposals, not just that double tax trap that I mentioned. So we've got the spouse exemption that will still continue, which means that pensions passed to a UK domiciled spouse or civil partner will remain IHT free on the first death. That defers the tax until the second death. But it means that the reforms disproportionately affect unmarried couples compared to married couples or civil partners, as they can't benefit from this particular exemption. Also, under the new proposals, if you leave a pension to your children, it won't be exempt from IHT, something that people can achieve under the current rules. Also, the proposed changes will indirectly impact the Residence Nil Rate Band, or the RNRB for short. This additional IHT allowance currently stands at £175,000 and is tapered down for estates exceeding £2 million. Now, as pension values will now be included in the total estate, more estates are likely to hit or exceed the £2 million threshold. That's because lots of people's wealth is not only accrued in property, but particularly in their pensions. So it means that more people could potentially see the RNRB reduced, which will therefore increase their overall IHT liability. There are also concerns about the inclusion of death in service benefits in the taxable estate. So what are people currently doing, given that there are plenty of people out there who have sizable pension pots, if they want to try and pass on as much of their wealth tax-free? Now, again, I've going to stress and say that nothing's changed and the proposed rule changes could be scrapped entirely, as we've already seen the government U-turn on their policies confirmed in the autumn budget. But the first thing I would say that the rule changes are a reminder to review your beneficiary nominations. So unfortunately, many people forget to add nominations on their pensions or review them when they get divorced, for example. So while some may prioritise their children in such nominations, if DC pensions do become liable to IHT, then nominating your spouse or civil partner will allow you to take advantage of the spousal exemption that I mentioned. Also, anecdotally, there are unmarried people who have been in long-term relationships who are now considering getting married for tax reasons. Also, some pension holders are now considering their beneficiaries' own income tax statuses when considering who to nominate in order to maximise the amount of wealth that gets passed on after tax. People are also considering optimising pension withdrawals. So the old advice of leaving pensions untouched may no longer be optimal for everyone. So for some, it may now make sense to use their pension pot to provide retirement income first and foremost rather than other assets, and to preserve those other assets to pass on to their next of kin. Now, one possibility is gradually drawing down to manage income tax and reduce the potential pension IHT exposed capital. So theoretically, you could withdraw enough to keep your taxable income below the higher rate income tax threshold, or even increase personal spending on things like holidays. However, you've got to be aware that taking flexible withdrawals from your pension can trigger the money purchase annual allowance, which reduces your annual contribution limit from £60,000 to £10,000 a year. So it's something to bear in mind, and that's why you should always seek advice before you access any pension benefits. The reason why some people are shifting to trying to preserve assets outside of a pension is that assets such as property and savings will only be subject to an IHT rate of 40%, even if they die after the age of 75. Another option open to everyone is making gifts from those other assets which could be potentially IHT free, which reduces your estate even further. There are a range of IHT exemptions which can be taken advantage of, for example the annual £3,000 exemption and the small gift allowance of up to £250 per person per year, and you can make specific wedding gifts of up to £5,000 for a child, £2,500 for a grandchild, or £1,000 for other people. There is a link in the description to give you full details of all of those exemptions and how they work. I'm not going to dwell on them here. So some people may even consider gifting to charity, which is obviously IHT free. But interestingly, there is another possible wrinkle that needs to be ironed out with the new proposals when it comes to charitable gifting. Currently, you can qualify to pay inheritance tax at a reduced rate of 36% if you leave at least 10% of your net estate to charity. So if your pension is now going to be possibly added into the mix in 2 years' time, it could mean that those who've designated a monetary amount to a charity upon their death won't now hit the 10% threshold, and therefore will end up paying 40% IHT on their estate rather than the 36% that they'd hoped. I know it's a nuance, but it's something to bear in mind if proposals are implemented, and some people will need to go back and review their wills. But it does also raise another interesting question, which is, will gifting to charity now become more attractive to some people if they can reduce their IHT rate? Now, there's always the option of making larger lifetime gifts, so that is outside of the exemptions that I've already mentioned, and they can qualify as potentially exempt transfers called pets, meaning there is no IHT to pay if you live more than 7 years after the date of the gift. Now, if you die before then the rate of IHT is tiered as shown on screen, and in this way some people are considering accessing their tax-free pension commencement lump sum, or tax-free cash as some people like to call it, in an attempt to mitigate the potential IHT liability on their estate through gifting that away. A powerful, often overlooked exemption with no monetary limit is the normal expenditure out of income exemption, or sometimes you hear it called the regular gift from income exemption. Now, gifts under this exemption are IHT free with no limit as long as they meet 3 strict conditions. So firstly, they must form part of normal expenditure, which means they are regular and habitual payments. HMRC typically looks for a pattern established over 3 to 4 years. Secondly, they are made entirely from income, not capital. This includes earnings. It can include pension income, investment income, and interest from savings. Crucially, pension drawdown withdrawals, including any tax-free cash element, can be treated as income for this purpose, provided the other conditions are met. However, income is generally deemed to become capital after 2 years if it's not spent or gifted. Now, I say that, and that is based upon some excellent notes from Aberdeen and their interpretation of the proposals going forward. So you have to bear that in mind. I'll put a link to that article in the description, because it is aimed at financial advisors, so I think it's still useful for people who are watching this to be able to see what people are talking about and the potential opportunities. But with anything that I mention in this video, you should always go and seek advice, because it isn't financial advice in any way, shape or form. The third point that you have to meet if you want to use that gifting from income exemption is the donor needs to retain sufficient income to maintain their usual standard of living after making the gift, and this includes all of your everyday expenses and lifestyle costs. Now, there are problems with the gifting from income approach before you even consider involving pensions. So there is the burden of proof. So the exemption is only claimed by your executors after your death. And the burden of proof that you've got to meet all of those criteria rests on them, and they've got to demonstrate that, which means they're probably going to need statements. So you are going to have to be very meticulous in your record keeping. The normal pattern criteria can be tricky to achieve and seems likely to be especially so with money deriving from a pension. As I've mentioned, that excellent briefing from Aberdeen on this topic is linked to in the description, and the suggestion at this stage is that taking a large one-off tax-free lump sum from your pension and then gifting it over a short period of time, say a couple of years, would probably fail the normal expenditure and from income tests. It would be difficult to establish a regular pattern of gifting in that initial period, and the lump sum itself may be deemed as capital, not income. So spreading the withdrawals over a longer period of time, similar to an annuity, is more likely to satisfy the exemption. So theoretically, if you meet all of the criteria for this particular gifting from income exemption, then it could be used to fund things like pension contributions for a beneficiary. Potentially, they could even claim tax relief based on their highest marginal rate. But ultimately, there is never any certainty at the time of gifting that the IHT exemption will be granted by HMRC. So if the claim is ultimately denied, then the value of the gifts made in the last 7 years will be brought back into your estate and treated as potentially exempt transfers, which could then be subject to IHT. But there are other IHT mitigation tools out there that people are looking into as well. So for example, you could take out a life insurance policy which is written into trust, and that could be possibly funded by pension income, and that would pay out in the event of your death, and it would cover the potential IHT bill that your estate would have. So for larger estates, there are other options out there like family investment companies and trusts, but it's way beyond the scope of this video. So while gifting ultimately is going to become more attractive if these proposals do come into force, I would say you've got to balance that against the financial needs that you're going to have in the future. So you might gift your money away, but nobody knows how long they're going to live or what their health might be in the future and what their health needs might be. Again, it's just a proposal at this stage, and what I'm really doing is just giving you some ideas that people are thinking about, and these proposals could be cancelled altogether. The thing is, you don't need to do anything right now, but it might give you a reason to go and seek advice anyway for pension planning and retirement planning generally, and even IHT planning. If you don't have a financial advisor you can trust, and we put a link to an article on the Money to Masses website in the description, which you will find incredibly useful.